Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Welcome to another Wealth Coffee Chats. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong live for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well.
Good morning, everybody. Welcome to another Friday edition of Wealth Coffee Chat, our Finance Friday. So, why did the loan officer bring a ladder to work? He heard that interest rates were going up. A little bit of fun this morning. I had an email. So I actually received an email yesterday in my inbox, which I found quite interesting. NAB sends us regular emails giving us updates in regards to interest rates, and I received an email to say that NAB were dropping their verbal rates between 0.4 to 0.6% for new loans. This is on their base variable rate. So we are now talking about variable rates dropping, even though the reserve, the RBA has not reduce the cash rate. So is that a sign of other lenders following suit or not? So I will keep you posted in regards to any news that I may receive around that. But what I will say is, if you're currently with NAB at the moment, it is probably a good time to reach out and have a conversation. I know that a lot of times the lenders don't usually offer the same rate as they do for new borrowings or new clients, but it never hurts to reach out and have that conversation with them. Today, I actually wanted to have a chat about being prepared to purchase, being prepared for investment opportunities. Now, over the weekend, we had our exit plan. It's an event for our clients to learn more about their structures and how to build out their wealth so that they can exit and build a life, create their financial freedom in their life. And at that event, we had the opportunity to see some exclusive investment property opportunities. And I noticed there was a difference between those who were prepared and those who weren't, and the ability to make decisions on investment opportunities because you know what you're capable of doing. The first thing we talk about when it comes to lending is servicing, and the second thing is security. Now, security we don't usually control, but we can create an idea of how much we're potentially able to purchase a property for, based on our savings, our access to funds, and our servicing. So when we look at income servicing specifically, the biggest area we need to understand is our income. When it comes to PAYG, there's a very simple calculation. We look at our pay slips and we can analyze that income. We can actually break it down to how much is our base income and how much is our overtime, and then we can add commission and bonuses on top of that. So that's fairly straightforward, and you can calculate that most of the time. There are a lot of servicing calculators out there that you can tap into to be able to work out those numbers yourself. When it comes to self-employed, it's a bit more complicated, and it will most likely involve your broker. Get them all the documentation, like financials and tax returns. Now, the thing with self-employed is that you could use, so say for example this year, you can still use your 2023 income. So between now and the end of this calendar year, you can still use your 2023 income to work out how much you can actually borrow. After the calendar year, the goal is to complete your 2024 and have it ready for lodgement. Does not actually have to be lodged with the ATO, but it needs to be completed. Once you've completed that, you then have the whole calendar year to use your 2024 financials. So once the broker runs through it, unless something dramatically changes in terms of your expenses, you have an idea of how much you can actually borrow. Now, there are other options in terms of lending when it comes to self-employed, like low doc using your BAS and accountant's letter. But as a general rule of being able to determine how much you can actually, how much you can borrow, it is best to have that information and run that information through with your broker, so that you know at the click of a finger that based on your 2023s, here's how much you can actually borrow and use. What is your borrowing capacity based on those figures? So between August and December is a great time to catch up with your accountants, get them all the information, and give them the time to be able to complete that, so that when an investment opportunity comes across, wherever you are in a position to be able to make a decision of whether you can and how much. Now, those with investment property portfolios, it is a great idea to actually create a summary of all your loans with all the basic information: interest rates, loan repayments, offset accounts, and linked offset accounts. And the reason why you want this is you want to be able to see a snapshot of your total lending, so that, again, you know where the money is going to actually come from when you're purchasing investment property, and whether that money is going to be cash that you have available. And if you've got cash that's available, then, and it's currently sitting against an offset against your home. So if you have cash, but you have a home, still have an outstanding home loan, then it's best for you to use that cash and change and convert a portion of your home loan into an investment loan. That will actually unlock more of how much you're actually able to borrow. Now, the other thing that we had a lot of conversations with clients over the weekend was, what entity are you purchasing the property under? And whether it's under a personal, under a trust, or under a self-managed super fund, it is a good idea to understand your next property, your next investment property, which entity is it actually going to be purchased under. The reason for that is that the reason why you want to know that is so that you can have that set up and have that ready to be able to be put on a contract. Now, depending on which state, Victoria offers a nomination clause, which means you can transfer it from your, let's just say your personal name, to a trust before the property settles, and you don't incur stamp duty again. But not a lot of states will enable you to do that. So having those entities set up in advance means that when an opportunity arises, you're ready to go. And the last thing that that has been a topic of conversation is obviously where the deposits are actually coming from. Is it cash that you have? Do you require an equity release? And how quickly can you have these funds available? Now, some vendors will accept deposit bonds, which is an unsecured facility where a lender guarantees the 10% of the purchase price. They don't take any security over any of your properties, but they do check to make sure that you have equity available in your properties. And for example, if it's an off-the-plan purchase, then you may require to show them that you've got equity up to 4 or 5 times the value of that deposit bond. So if it's 100,000, then you need to show them you've got equity up to 500,000. However, they don't secure anything on any of your properties. The other deposit option that's available is a bank guarantee. And with bank guarantees, it does require you to provide the bank security, and the application process for that security is similar to actually applying for a loan. So that may delay how quickly you can get that and make that available to the vendor. G'day, Jeff. Thanks for joining me. Now, one of my team had a client, and the discussion around the deposit and where the deposit came from made the difference between the loan being approved or not. Now, this client had told my team, my broker, that they had the funds for the deposit and it was cash. And when we looked further into it, we realized that what they determined cash was an equity release that they already had available, and the funds were sitting in an offset account. And so, yes, everybody just looks at it and goes, okay, that's cash. But when you take that money out to use it, it triggers a loan. And when it triggers that loan, it means that loan, the funds were used for a particular purchase. And in this case, the funds were being used to purchase an investment property. The original application to the lender was coming back and the servicing was failing. And the lender said that the client could only borrow, I believe it was like a maximum of 450,000, and the clients needed $500,000. Because we were able to work out where the deposit was coming from and how that actually affected the loan structure, we were able to go back to the bank and actually say to them, the home loan debt wasn't $1 million. It was now only 600,000 because 400,000 of that was being used as an investment loan. Here's the loan account and here's the split. Once we replied that information to the lender, they came back and approved the loan at the full amount that we requested. So we have to be very careful to understand, obviously, where the deposit is coming from, but also understanding that where the funds are currently sitting can actually affect how much you can actually borrow if it's not presented in the correct way. Now, you can imagine, had we not picked this up and let the lenders know, then the clients would have to fork out additional funds in order to make the deal work. So it was an amazing result from my team, but it just outlines the importance of knowing the actual loan structure and asking the right questions in order to make sure that the deal works. That's all I have for today. I hope that's been useful. If there is any questions in regards to any of this information, have a chat with your broker about it. Always make sure that you're prepared for any investment opportunities that come across, that becomes available in your world, because you never know when you actually need finance and how quickly. Have a wonderful Friday. I look forward to catching up with you next week, and have an amazing weekend. Hi, James. Thanks for joining us.